Picture this for a second. You're sitting at your kitchen table. It's a Sunday night, and you've got one of those retirement calculators pulled up on your laptop. You type in a number, $1 million, because honestly, that's the number everyone talks about, right? The $1 million retirement. It's been drilled into our heads since we were 20-something and just started our first 401k. And for a second, seeing that number pop up feels good. It feels like arrival, like you finally made it to the mountaintop everyone told you to climb toward. And then you sit with it a little longer, and a weird, quiet anxiety creeps in. Because is $1 million actually a lot of money anymore? Is that enough to, actually live the way you pictured? Or is it just a big, scary-sounding number that doesn't translate into much of anything once you actually try to spend it? That right there, that gap between the number and the reality, is basically what we're going to dig into today. My name is Steve, and I spend way too much time thinking about money, retirement planning, and why a number that sounds enormous on paper can feel surprisingly modest once real life gets involved. I've looked at this stuff from a lot of angles: client portfolios, spreadsheets, late-night rabbit holes on withdrawal rates, and I keep coming back to the same realization. Most people have no real, tangible sense of what $1 million actually converts into. Not in vague, that's a lot of money terms. I mean in actual monthly grocery store, rent check, doctor's visit terms. So today, we're going to pull back the curtain on that. We're going to talk about what $1 million portfolio really buys you month to month, why the answer massively depends on where you live and how you think about risk, and, maybe most importantly, why chasing a specific number might be the wrong goal entirely. By the end of this, you might walk away thinking about your own retirement completely differently, maybe with a little more clarity, maybe, honestly, with a little more peace of mind than you came in with. Let's get into it. Okay, so first let's just sit with why $1 million feels so magical in the first place. Honestly, I think it's kind of an arbitrary cultural artifact. It's a round number. It's got that satisfying number of zeros. Millionaire is a word that's been baked into our brains since childhood. From board games to movies to that one relative who always talked about when I make my first million. It represents this vague cultural shorthand for made it, for financial freedom, for never worrying about money again. But here's the thing. $1 million in, say, 1990 is wildly different from $1 million today. Actually, let's do a quick gut check. Because of inflation, $1 million today has roughly the purchasing power that around $400,000 had back in 1990. Let that sink in for a second. The number stayed the same in our cultural imagination, but the actual buying power behind it has quietly eroded like a beach losing sand one wave at a time. Nobody sends out a memo about that. It just happens. So when someone says, I want to retire with $1 million, what they're often actually picturing is some fixed lifestyle. Trips, a paid-off house, dinners out without checking the bill twice, and they're just plugging in the number that sounds big enough to represent that dream. But the number itself doesn't actually promise any of that. It's just a number. What matters is what it can generate, year after year, without running dry. And that's really the heart of today's conversation. Not is $1 million a lot, but a lot of what exactly and for how long. Here's a simple breakdown that financial planners lean on a lot. It's called the 4% rule. Basically, the idea is that if you withdraw about 4% of your portfolio in year one of retirement and then adjust that amount for inflation each year after, your money has a historically strong chance of lasting through a 30-year retirement without you running out. It's not gospel, it's not perfect, but it's a useful starting point for the math. So for $1 million, 4% is $40,000 a year. That's it. That's the headline number. $40,000 a year, or a bit over $3,300 a month before taxes. Now sit with that for a second. Does $40,000 a year sound like never worry about money again money to you? For some people in some places, doing some things, actually, yeah, it kind of can be. But for a lot of us, especially folks picturing a certain kind of retirement, that number lands a little underwhelming. And that gap right there between expectation and reality is exactly why so many people get blindsided in their 60s. Let's make this real instead of abstract, because abstract numbers are basically meaningless until you attach them to actual life. Say you've got that $3,300 a month coming in from your portfolio. Add in Social Security. Let's say a modest but fairly typical benefit of around $2,000 a month for an average earner. Now you're at roughly $5,300 a month in income. Suddenly it looks a little more livable, right? That's the thing people forget. The million-dollar portfolio is rarely operating alone. It's usually one leg of a three-legged stool, alongside Social Security and maybe a pension if you're lucky enough to have one. But here's where geography just barges into the conversation and completely rewrites the story. $5,300 a month in, say, a small town in Ohio or rural Tennessee. That can genuinely fund a comfortable, unhurried retirement. Modest home paid off, groceries covered, some travel, dinner out on Fridays, maybe helping the grandkids with something now and then. It's not lavish, but it's peaceful. It's enough. That same $5,300 a month in, say, coastal California or Manhattan or Honolulu? Honestly, it might barely cover rent and health care, let alone the lifestyle people associate with retired comfortably. Same portfolio, same $1 million, wildly different outcomes depending on your zip code. It's almost unfair how much geography quietly dictates your retirement reality. Nobody really tells you that when you're 25 and just trying to max out your Roth IRA and healthcare. Oh man, healthcare deserves its own little digression here, because it's the wild card nobody budgets for properly. Studies have estimated that the average retired couple might need somewhere in the ballpark of $300,000 total to cover healthcare costs throughout retirement. And that's before we even talk about long-term care, which is a whole different, much scarier bucket of numbers. So when you're looking at that $1 million, you kind of have to mentally set aside a chunk of it just for the body starts needing more maintenance phase of life, which, let's be honest, is coming for all of us eventually. The takeaway here isn't panic, it's get specific. Don't just ask, is $1 million enough? Ask, is $1 million enough for my actual life, in my actual location, with my actual health situation? That's a completely different, much more useful question, and it's one you can actually build a plan around. All right, this next one is something I genuinely think doesn't get talked about enough, and it's called sequence of returns risk. I know. Sounds like homework. Stick with me because this one's actually kind of fascinating in a slightly terrifying way. Here's the idea. Imagine two people. Both retire with exactly $1 million. Both withdraw the exact same amount every year. Identical portfolios, identical withdrawal strategy, identical average return over 30 years. You'd think they'd end up in the same place, right? Same inputs, same outputs. Basic math, except they don't. Not even close. Here's why. Let's say person A retires right before a nasty market downturn, a rough couple of years where the market drops 20–30%. They're withdrawing money during those down years, which means they're selling investments at low prices just to generate income. That digs a hole in the portfolio that's brutally hard to climb out of, even when the market eventually recovers, because there's simply less money left to participate in that recovery. Person B, meanwhile, retires right before a strong bull run. Their portfolio grows for the first several years even while they're withdrawing money, because the growth outpaces the withdrawals. By the time any downturn eventually hits, they've got a much bigger cushion to absorb it. Same average return over 30 years, wildly different outcomes. One person might run out of money by their mid-80s, the other might die with more than they retired with. It's basically about timing and luck as much as it's about diligent saving. And I think that's kind of an uncomfortable truth that doesn't get said out loud enough. We love to believe that if we just save diligently and invest wisely, the outcome is fully in our control. And to a large degree it is. But there's this element of when were you born and when did you retire that genuinely shapes your fate in a way no amount of budgeting spreadsheets can fully protect you from. So what do you actually do with that information? Well, this is where things like keeping a cash buffer, enough to cover maybe 1 to 3 years of expenses sitting in something safe and boring, becomes less about being overly cautious and more about being strategically defensive. If the market tanks right when you retire, You don't have to sell your stocks at rock-bottom prices. You just live off the cash buffer for a while and let your investments recover in peace. It's not glamorous advice. It's not exciting. But it's the kind of quiet, unsexy strategy that actually protects people from the worst version of bad luck. Okay, let's shift gears a little because I think we talk about retirement almost entirely in financial terms, and honestly, that's only half the story. Here's something that surprised me when I started really digging into retiree research. A huge number of people who retire with what should be, on paper, more than enough money still report feeling anxious, even a little lost. Not because the math doesn't work, but because for decades their identity, their daily structure, their sense of purpose was tied to a paycheck and a job title. And then, one day, that's just gone. And the portfolio, no matter how big, doesn't replace that. There's actually kind of a bittersweet irony in it. People spend 30, 40 years grinding, saving, sacrificing little pleasures now for security later. And then when later finally arrives, some of them don't really know what to do with themselves. It's like training your whole life for a marathon, and then, right after you cross the finish line, someone hands you a second marathon with no map. I bring this up because $1 million can absolutely buy you freedom from financial stress. That part's real, but it can't automatically buy you a sense of meaning or purpose or a reason to get out of bed with excitement on a Tuesday morning. That part, you kind of have to build separately. Hobbies, relationships, maybe some part-time or volunteer work, a project you've always wanted to sink your teeth into. The money is the vehicle. It's not the destination. So if you're planning your retirement, don't just build a spreadsheet. Build a life to go along with it. Ask yourself what you're actually retiring toward, not just what you're retiring from. That single mental shift from escaping work to moving towards something tends to make an enormous difference in how fulfilling those years actually feel. All right, here's maybe the biggest reframe I want to leave you with. Chasing $1 million as this fixed, sacred target is honestly kind of the wrong way to think about retirement altogether. Because what actually matters isn't the size of the pile. It's whether that pile, combined with Social Security, combined with your actual spending habits, combined with your location and your health and your risk tolerance, can sustainably fund the life you want for as long as you need it to. Some people could retire wonderfully on $600,000 because they've got low expenses, a paid-off home, and modest tastes. Some people would burn through $2 million uncomfortably fast because their lifestyle and expectations are simply bigger. Neither of those people is doing it wrong. They're just different equations. So instead of asking, "Do I have $1 million yet?" a much more useful question is, what does my monthly life actually cost? And what sources of income do I have lined up to cover that reliably for 30-plus years? That's a completely personalized question. Nobody else can answer it for you, and no single number, not 1 million, not 2 million, can be universally slapped onto every retiree's situation like a one-size-fits-all label. This is also, honestly, where working with a real financial planner, even just for a single sit-down session, can be worth way more than another hour of doom-scrolling retirement calculators online. Because a good planner isn't handing you a magic number. They're helping you build a personalized model based on your actual life. And that, more than any headline figure, is what actually determines whether your retirement feels secure or shaky. So let's bring this all back together for a second. $1 million sounds enormous, and culturally, it carries this whole mythology around it. But on its own, it's just a number. What it actually buys you depends on where you live, how healthy you are, how the market behaves in those crucial early retirement years, and honestly, how you've defined enough for yourself. We talked about the 4% rule and what that $40,000 baseline really translates to in daily life. We talked about how geography can completely transform the same dollar amount from comfortable to tight. We talked about sequence of returns risk, that sneaky, luck-based factor that can shape your entire retirement regardless of how disciplined you were with saving. And we talked about the emotional side, the part where money alone can't hand you purpose or meaning, that part you build yourself. If there's one thing I hope you take away from all this, It's that the goal was never really get to $1 million. The goal is understanding your own life well enough to know what you actually need, and then building toward that with intention, rather than just chasing a round number because it sounds impressive at a dinner party. Retirement isn't a finish line you cross with a trophy. It's a whole new chapter, one that deserves just as much thought, curiosity, and honest self-reflection as any other big decision in your life. So maybe this week, instead of just wondering, do I have enough, sit down and actually get specific. Look at your real expenses. Think about where you actually want to live. Think about what you want your days to feel like, not just what they cost. You don't need a perfect number. You need a plan that fits you. And honestly, that's a much more achievable, much more human goal than chasing a myth. Take care of yourselves out there, and I'll see you in the next one.